In his book, One Up on Wall Street, Peter Lynch, an American investor and fund manager, describes the rules of his investment strategy, which we will discuss in more detail in this video. The investment strategy of Lynch is based on fundamental analysis and is a long-term buy and hold strategy. It focuses on finding growing companies with reasonable to low valuation. So although it has some factors of growth investing, it leans more towards a value investing approach. Pure growth investment strategies often have a technical analysis and market timing component. Lynch does not take advantage of this. He recommends leaving market volatility aside and focusing purely on building a long-term diversified portfolio that takes into account primarily valuation, profitability, and the overall financial health of a company. Companies are allowed to grow, but only at a pace that can be sustained over the longer term. He excludes companies that grow too fast. And does it work? Well, it certainly worked for him. As the manager of the Magellan Fund, Lynch managed to achieve an average yearly return of more than 29% in the period 1977 to 1990, doubling the average return of the S&P 500. According to Lynch, many good investment ideas can come from things you use, like, or buy in your everyday life. The company does not need to be active in the next hot or growing thing, but just has to provide goods or services which are appreciated in their specific field. Companies can perfectly be involved in relatively dull areas. In fact, often the more dull and understandable, the better. Often as a retail investor, you can use your first-hand experience to your advantage. Companies which have not been discovered by Wall Street yet and will often have low analyst coverage and institutional ownership can often be very interesting. So when you notice a specific product, service, or item turning up more and more, always check out the company which creates it. The next step is to dig into the company. Long-term investors cannot run the stock screener and just buy the companies that come out. Before actually buying, you need to do your homework and make sure you understand the business of the company. So the screener will just give you a list of companies to research. After buying shares in a company, the next step is patience. Lynch stated that you cannot make any sensible prediction on the price of the company or the market in the next 1 or 2 years, but over 10 or 20 years the price is more predictable. A portfolio of 10 to 30 well-selected and diversified stocks should perform well throughout 10 to 20 years. The Peter Lynch screen is available in our Trading Ideas section. In this part of the video, I will go over the rules of the screen manually. Solid earnings per share growth indicates greater value because investors are willing to pay more if they believe the company has higher profits relative to the prevailing stock price. The ratio indicates how much money a company makes for each share of its stock and is a widely used metric for estimating corporate value. Earnings per share is calculated by dividing a company's net income by the number of common shares the company has outstanding. In Chartmill, go to the Stock Screener page and select the Growth tab. Use the item EPS-Growth 5 years and change it to minimum 15 and maximum 30%. Higher growth rates are not sustainable in the longer term. In your further research, it will be important to understand how the company achieved this growth, and you will also need to assess whether the same kind of growth can be maintained in the future. Annual and quarterly reports of the particular company are the main sources of information to get a good idea on this matter. The next filter used is the price to earnings growth ratio. This ratio uses the price to earnings ratio but adds expected earnings growth to the calculation to arrive at a more accurate assessment of a company's value. After all, companies whose revenues, earnings, and cash flow are assumed to grow at a sufficiently high rate are more attractive and valuable than those with only limited growth opportunities. The formula behind this ratio is simple. You divide the price to earnings ratio by the company's expected growth rate. A number less than 1 is an indication that a company in question is undervalued. If the result is higher, there is a chance that it is overvalued. Peter Lynch himself states that the price to earnings expectation and the expected growth should ideally be balanced. Again, we use a 5-year average with a maximum of 1. Select the Valuation tab in the Stock Screener and set the PEG past 5 years to at most 1. The next filter is the debt to equity ratio. This ratio allows to understand how solvent the company is in the long run. It shows the relationship between equity and debt. thus providing insight into the company's capital structure. Total debt is measured against total equity. Raising external capital is not negative in itself, but it is important that the debt remains manageable for the company. If debt is much greater than equity, then the company has high debt and a capital structure that is riskier for those investing in it. In the screener, adjust the debt to equity filter through the Held tab. Change the value to at most 0.6. This ensures that the company is funded more by equity than debt. Lynch would tighten this even a little further, preferring a debt to equity ratio below 0.25. Combined with the other filters, however, we use 0.6 as the upper limit, and you can still change this afterwards if desired. The current ratio is just like the debt to equity ratio, another liquidity ratio used by Peter Lynch. This ratio shows the extent to which the company is able to pay its current liabilities at maximum 12 months with the current assets on the balance sheet. To calculate the ratio, a company's current assets such as cash and inventories are set against current liabilities such as wages payable and taxes. A ratio lower than 1.0 indicates that the company's liabilities due within a year or less are greater than its assets, cash or other short-term assets expected to be converted to cash within a year or less. To avoid this, the current ratio is set at a minimum of 1. You'll find the current ratio under the Held tab. Set the slider to minimum 1. Return on equity is set as the last specific filter. This ratio is calculated by dividing net income by equity. It is a commonly used metric to measure a company's profitability, as well as how efficiently it is done. The higher the return on equity, the better management succeeds in generating revenue and growth through equity financing. What percentage is used as a minimum depends greatly on the sector to which the company belongs. In this screen, under the Profitability tab, a standard minimum of 15% is used, which in itself is quite a strict selection. Be sure to compare this ratio with competitors in the same sector to get a good estimate. Finally, we also set a minimum daily volume of 100,000 shares using the General tab. We do so to ensure sufficient liquidity. You could argue that this is less important in a strategy focused on the long term. We therefore suggest checking the results both with and without this filter. That way you can be sure you won't miss any interesting companies. There are a number of other characteristics that Peter Lynch cites in his book, but which are outside the core of these basic filters. We have not added those as screening filters, but you can check them through the profile page of the company in question. Institutional ownership. According to Lynch, the best bargains can be found in companies that are barely being followed by analysts or where institutional shareholders do not yet own a significant portion of the stock. Insider purchases. Directors buying shares of the company themselves is a sign of confidence in the company's prospects and thus a positive sign. Both insider purchases and percentage of the stock held by institutionals can be checked via the company's profile page using the Ownership tab. Buying back own shares. Lynch prefers companies that buy back their own shares. After all, most companies do so only when they are convinced that the current value of the stock is a lot lower than its intrinsic value. Cash is king. Free cash flow allows companies to pay dividends, buy back their own shares, or make acquisitions. It is undoubtedly a hugely important indicator, and companies with enough cash on their balance sheet are much better armed when the economy slows down. And perhaps the biggest advantage of free cash flow is that it is much harder to manipulate than earnings. You can access information on stock buybacks as free cash flow through the Financials menu. Select the Cash Flow tab where you can find more details. And even more detailed information can be found in the quarterly and annual results released by the companies themselves. To view the results, you can proceed in several ways, and to do so, click on the inverted triangle in the horizontal blue bar and make a selection. There are many predefined views available. If you want a quick overview with charts, you can choose charts or two charts. With two charts, you get by default two charts of the same stock, side by side, which you can set separately in terms of time frame, indicators and overlays. If you want to focus more on specific growth or value parameters, you can choose one of the different column views such as growth or value. Through the custom option, you can create fully personalized tables and columns. As I already mentioned earlier in the video, it is recommended to compare companies from the same sector. To do this, choose the General tab and select the desired sector, for example, industrials. Now you will only get to see the stocks from that specific sector. Then you can apply a trend filter, for example. Select the Technical Analysis Indicators section and via the Chartmill Trend tab, select Long-Term Trend Positive. Chartmill shows only the stocks that meet this filter. The number of results changes at the same time as you set the filter. In addition, the website article also lists the filtering options based on the Piotrowski F-score as well as the return on invested capital. The Piotrowski F-score was developed by Professor Joseph Piotrowski and it is primarily used for value investing. The score is based entirely on fundamental analysis and it reflects fundamental health based on a rating between 0 and 9. The higher the score, the better. You can set it as a filter through the Health tab. Below I add a direct link to an article that explains more about this F-score. Return on invested capital reflects how efficiently capital is used to generate profits. It is an important ratio for quality investors, but also for those more focused on value investing. This is a very interesting ratio that offers a number of advantages over the classic return on asset or return on equity. You can read more about it in our documentation section. A link can be found below in the description of this video. The return on invested capital filter and 2 more variants are available through the Profitability tab. Finally, companies from this basic list that you want to investigate further can be quickly moved to a separate watch list. You do so by clicking on the plus sign. Then select an already created watch list or you create a new one by clicking on Create New at the bottom of the drop-down menu. So that concludes this video on the Peter Lynch method for screening stocks in Chartmill. If you have any more questions, please leave them in the comment sections below this video. And finally, we would greatly appreciate it if you give this video a thumbs up and subscribe to our channel. That will help us tremendously to create more similar content. So far, thanks for watching and we'll see you soon in the next video.